Hello Nigerians, come close. You have a new monetary policy regime in place as we speak. The Central Bank of Nigeria's Monetary Policy Committee rose up from a 2-day meeting attended by 12 members of the committee, and they have come to the conclusion that one major way to fight the current inflation ravaging the Nigerian economy is to raise minimum interest rates. So across board from 18.75% as at July 2023, the new monetary policy rate is now risen by 400 basis points to 22.75%, highest since 2006, and our cash reserve has been raised also up to 45% from 32.5%. Liquidity ratio remains at 30%. What is all these jargons about? What are these technicalities? I'll explain. First of all, cash reserve ratio is the minimum amount the CBN instructs financial institutions and banks to leave with the CBN. That's in the form of cash or deposits. All right. So as we speak now, that minimum to be left with CBN has just been increased, which means the whole idea is to minimize cash in circulation. One. Number two, monetary policy rates increase to 22.75% is to fight the current inflation that continues to ravage the Nigerian economy, which stands at 29.99% based on figures from the Bureau of Statistics. As we speak, monetary policy rate hikes is one of the ways that governments and central banks around the world uses to fight inflation. How does it fight inflation really in an economy? When monetary policy rates are increased, it simply means the rate for borrowing money, the interest you have to pay to financial institutions when you borrow money from them, has suddenly increased. So the idea is, because of this increase from 18.75% to 22.75%, suddenly borrowing is seriously discouraged. People do not have the hunger, the thirst to borrow much more. So when borrowing is reduced, there is less money in circulation. And usually, when there is less money in circulation, people tend to be more careful with their expenses. I'll give you an instance. Indomie noodles, the most popular noodles product in the Nigerian market, is now so expensive. Some people buy it for about 11,000 from 4,000 something last year. So people will start looking for alternatives. There are various alternatives, mini-me noodles and so on and so forth. These alternatives will come into play. People will begin to be more careful in their expenditures. When there's not much cash in circulation, the forces of demand and supply now means that people will pay less for goods, and then the rise of inflation will eventually be slowed down. But it takes a process, and this is not the only process to do that. Other means of fighting inflation abound, which is increase production, keep the farms safer, make sure that food production is increased, and most importantly, energy costs. Because the moment energy cost is reduced, I'm talking about petrol or petroleum products. Once prices reduce on those products, transportation reduces, and so foodstuff will also reduce, because you need transportation to move the goods from the farms, from the hinterlands onto the cities. And when fuel prices continues to escalate, definitely food prices will increase. And the moment food prices increase, every other thing will increase, because transportation increases based on energy cost. That's talking about fuel. All right. So as much as raising minimum interest rates is concerned, it has its own limitations. Experiences from the past during the post-COVID era shows that rates hikes has not effectively attended to or put inflation to the barest minimum. That's because there are many other things that spikes inflation, like I have just explained. All right. The effect of this minimum increase in rates now is that, first of all, the stock market will experience less money, because a lot of institutions borrow money from the banks to invest. Now that it is more expensive, 22.75% is quite high. It means that they will borrow less, meaning the stock market will see less money. When less money chases there's entire market, what you find is stock prices will drop versus, or contrary to when there was much more money in circulation chasing the number of stocks in the stock market. Now, in the real estate sector, it's also going to be badly affected because suddenly institutions and real estate companies that borrow money from the banks to develop their properties for sale and so on, for rental and so on, will find it more expensive to do so, meaning they will minimize the volume of borrowings or debts they are going to be getting into. So this is also going to affect the cost of building materials as well and rents if it lingers for too long. But most importantly, in the midst of all of this, there is always a positive somewhere. That's what I've come to realize. So while some sectors are going to struggle in the course of this, there are sectors, for instance, if you are in the stock market, that you can align with to take full advantage. One key sector that's going to benefit from this MPRO hike is the banking sector. How? Because suddenly they're going to be enjoying much more interest on the loans that they will be giving out, even if in the long run the volume of borrowing will reduce, but in the short run whatever they're going to earn will increase from 18.75% to 22.75%. So you watch out for the bottom line of banks. Their earnings and turnovers will increase in terms of monies borrowed out and earnings coming in as interest. All right. So if you want to be wise, you hold on for the stock market to react to this. When stocks bottoms out, then you look for a safe haven in the Nigerian banking sectors that are strong banks, tier 1 banks, that you can invest your money to benefit also. So we look forward to increased performances in terms of their financial reports towards the end of the year for most of these banks. So those who borrow are going to struggle, including manufacturers. They will struggle with this new regime. For you as an individual, it is time to cut costs as much as possible. Think twice before you spend. No more impulsive spending, just to keep safe and still maintain your standard of living. But by all means, inflation is now 29.99%, and your salary is still not getting increased. There has to be something to do, which is to find another means to make your money grow for you, or get a side hustle. This is my advice for you while we keep going. Nobody has died of inflation. You can find your way through this, and I'm sure you can be better for it. In the long run, we watch to see how inflation is brought to its barest minimum. Keep safe. All the best. Let me know your take on this. Like, share, and keep following.